transferring money from overseas as a down payment when you're buying a home in Toronto? Here are the fees and timings you need to know about. But before we dive into that, let me share something that might surprise you. There's actually a way to buy a home in as little as 5%, even if you're new to Canada. And by the end of this video, you'll know exactly how much you need to save, where the money can come from, and most importantly, the one thing that could add an extra $15,000 to your purchase that most first-time home buyers completely overlook. If you're new here, I'm Lay, helping newcomers and first-time buyers navigate the Toronto market. Make sure to subscribe because we're covering everything you need to know about buying your first home in Toronto. The real down payment numbers. Let's start with the basics that everyone gets wrong. Most people think you need 20% down to buy a home in Toronto. That's not true. According to the Government of Canada's official guidelines, here's what you actually need. For homes that are $500,000 or less, you need just 5% down payment. And for homes between $500,000 up to $1.5 million, you need 5% for the first $500,000 and 10% for the remainder. Let me show you how this works with real Toronto numbers. If you're looking for an $800,000 condo, which is pretty typical in Toronto right now, so 5% of the first $500,000, which is $25,000, plus 10% of the remaining $300,000 equals $30,000. So that's a total minimum down payment of $55,000, not the $160,000 that 20% would require. Now, if you're wondering whether this applies to you as a newcomer, the answer is yes. But there's a catch. I'll explain it in just a minute. The CMHC insurance reality. Here's where it gets interesting and why I said there was something most buyers overlook. When you put a down, which is less than 20%, you're required to purchase a CMHC mortgage insurance. This protects the lender, not you, if you can't make your payments. CMHC is a crown corporation that makes it possible for home buyers to put in as little as 5% down payment. Without it, the minimum down payment you need is 20% of the purchase price. The cost ranges from 0.6% to 4.5% of your mortgage amount, or that's the loan amount, depending on your down payment size. Using the same example that we had earlier for $800,000 condo, for example, with $55,000 down payment, your mortgage would be $745,000. Now, here's where it gets interesting. On top of that, you have to pay CMHC insurance. And at 3.1%, that is $23,095. This amount is added to your mortgage. So you're actually paying a mortgage of $768,095 instead of $745,000. But here's the part that surprises people. If you add your premium to your mortgage, you pay an interest on your premium for the entire 25 to 30 years. But here's the part that surprises people. If you add your premium to your mortgage, you pay interest on the full term, whether it's 25 years or 30 years. In the end, that $25,000 premium becomes $50,000 interest over the course of 25 to 30 years. Stick with me because I'm going to show you how to minimize this cost. And there's actually a program specifically for first-time buyers that can help. Now, as a newcomer, you might be thinking of transferring your funds from overseas. Here's what you need to know. Normally, the minimum down payment must come from your own funds, according to government guidelines. But there are some acceptable sources. Number one, your savings, obviously. Number two, gifted funds from your immediate family. So who are your immediate family? your mom, your dad, your stepdad, your stepmom, your aunt, and your uncle or your brother and sisters. But this needs to have proper documentation, including having these people sign a declaration document that they are not going to ask back this money from you. That's why it's a gift, not a loan. Our RSP or Registered Retirement Savings Plan withdrawals through home buyers plan up to $60,000 per person. I will make a video on the details of home buyers plan and how an RRSP can help you fund your down payment in another video that I am creating, and you will see it pop here once it's completed. Otherwise, subscribe to my channel so that you will know when this video is uploaded. Number 4, sale of assets like investments for property. If this property is outside Canada, you need proper documentations for that as well. So for international transfers, banks typically require paper trail showing the source of funds. If this is a gift from your parents, which are overseas, you need the proper paper trail as well. Now, there's a currency conversion involved, and there's wire transfer fee, typically $15 to $30 plus exchange rate margins. So the processing time for this is about 3 to 5 business days. If you're dealing with international transfers, I work with clients on this regularly. So feel free to reach out if you need a specific guidance. So what are the programs that you might actually qualify for? Here's where it gets really interesting for newcomers and first-time homebuyers. While the original first-time homebuyer incentive ended in March of 2024, the federal government announced a $5 million repayable loan to Arboro Inc., which will fund shared equity mortgages that they will provide directly to first-time homebuyers in the Greater Toronto Area. This is similar to the first-time homebuyers incentive, but this time it will be funded by a private organization. And you can have it up to 20 years. If you need to sell, then you have to return that portion in percentage from the proceeds of the sale. With the shared equity program, you will subtract your mortgage payment. So over the course of 15 to 20 years, when you're ready to sell, let's say you have paid up $6,000 every year. So let's say 20 years, $120,000. So when you sell this property, you will subtract that amount, which is a principal that you have accumulated from the proceeds. And then from there, whatever that proceeds is, let's say they lend you 5% of your down payment, then they will take 5% shared equity. Plus, there are still other programs available. As I said earlier, our RSP Home Buyers Plan, which now let you borrow up to $60,000 per person. Now, there's also provincial land transfer tax rebates for first-time buyers, and also some municipal programs in some GTA areas. Here's something most people don't know. The maximum amortization period for a CMHC insured mortgage has been extended to 30 years for first-time home buyers who are thinking of buying brand new homes. This can significantly lower your monthly payments, making home ownership more accessible. Let's talk about the real cost calculation of buying a home in Toronto or anywhere in Canada. Let's put this all together with a real example that applies to most of newcomer clients. So let's say for the $800,000 Toronto condo purchase with a minimum down payment of $55,000. CMHC insurance is $23,095. This is added to the mortgage. So your actual mortgage is $768,095. Amortized over the 30-year period and at 5.5%, approximately $4,350 monthly payment. So compare this with a 20% down payment scenario. So if you are paying 20% down payment to ensure you don't have CMHC, you are looking at about $160,000 down payment. A mortgage of $640,000. And comparing it with a 25-year amortization at 5.5%, you're looking at about approximately $38.50. The difference is you need $105,000 less upfront, but you'll pay about $500 more per month. There is no going around this. Remember, if you're planning to pay on a longer amortization, that means you are going to pay less. But over the course, you are paying 5 extra years, and those interests accumulate. In the end, you are paying more interest, but it is easier for you and more affordable on a monthly basis. You have to measure which is more important for you. If you can only manage to pay with smaller amount of monthly payment, then go with a 30-year amortization. That at least gives you the opportunity to become a homeowner. Now, the question is, what scenario works better for your situation? This is exactly the kind of analysis I do with my clients to help them make the right decision. How about you? Would you rather pay less upfront or save money on interest and pay a little bit extra? By the way, I have a new video that talks about mortgage savings. By paying a little bit extra every time, it will save you years and a lot of interest in the process. So check that out. If you're not subscribed yet, what are you waiting for? Now, here's what we haven't talked about yet. And this is crucial. That $55,000 down, it's not the total amount you need to have saved. You also need to think about closing costs. For example, legal fees, land transfer tax, moving costs, inspection, maybe appraisal fee, and other disbursements, equivalent to 1.5% to 7% of purchase price, depending on what type of home you are buying. According to CMHC, on an $800,000 purchase, that's potentially another $12,000 to $32,000 you need to budget for. What are these costs exactly? Which ones can you negotiate? And which one catches newcomers completely off guard and can add up to $15,000 to your closing? I'm breaking down all the hidden costs of buying your first home in Toronto in the next week's video. Make sure you're subscribed and hit the notification bell so you don't miss it. If you're ready to start your home buying journey and want to work with someone who understands the newcomer experience, because I've been there myself, reach out to me. My contact information is in the description below. Now that you know everything you need to know as a newcomer when you're thinking of buying a home, watch this next video where I talk about the hidden cost of buying a home. See you in the next video.